What's the fastest way to improve your credit score? Does paying a credit card even one day late hurt your score? And what must you do to get a FICO credit score in the first place? We'll answer these questions and more on this, the second episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Hey everybody. Hey, whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the show to help you take your finances to the next level. I tell you, I'm really excited about our show today. This is the second podcast, so it's been fun trying to figure out how podcasts work and working out all the kinks in the audio and the kinks with interviewing folks over Skype. And I think I've got most of those technical issues out of the way. And on this show, we're going to talk about, I think, probably one of the most confusing aspects of personal finance. Certainly in my 6 or 7 years of blogging about personal finance, I get more questions about credit scores than probably any other topic. What's the difference between a credit score and a credit report? Can I get both of them for free? How do I improve my credit score? What happens after bankruptcy, and how long will it take me to buy a home? I mean, the questions just go on and on and on. And so I'm excited today. We're going to be interviewing Tom Quinn, who is the credit expert from FICO. And FICO, it's interesting. I was having a conversation with some good friends the other day in advance of my interview with Tom. And I asked them if they understood what FICO was. And their first response was, yeah, that's the Social Security tax you pay, right? And I said, no, that's FICA. FICO is the company that created the credit scoring formula that is used today by most lenders. Mortgage companies use it when you apply for a home loan. Lenders use it when you apply for a car loan. While there are some other scoring formulas and models out there, FICO is by far the one used the most when you apply for a loan. It's used for other reasons too. It's used in part when you apply for auto insurance. Believe it or not, they'll check your FICO score sometimes when you get a cell phone contract or a cable or satellite contract for TV. Anything that requires you to make payments over time, your FICO score often comes into play. And so I was thrilled when Tom and the folks over at FICO agreed to an interview. I told them I was going to be asking a lot of questions that readers had sent in. And, some of them are really tough, and some of them don't have easy answers, but I think you'll see that Tom did a great job. And so I'm grateful that he's came on the show to help deal with some of the confusing issues that credit scores present. Before we get to his interview, I just wanted to cover a couple of things to underscore just how important your credit score is. And I was on the MyFICO website. And by the way, I'll include links to all of this in the show notes, which you'll be able to find at doughroller.net/podcast2. That's podcast followed by the number 2. I'll have links to everything that Tom talks about that I talk about. But I was on the MyFICO site, and one of the things that they provide, and I've written about this before on the blog, is how the interest rate will change for a mortgage based on your credit score. And it really shows you how important your credit score is. For most mortgages, you need a credit score of at least 620 to qualify for the mortgage. But of course, the higher your score is, typically the lower the interest rate you'll qualify for. And at today's rates, at a score of 620, according to MyFICO, you'll qualify for a mortgage on a 30-year fixed loan of about 5.5%. Now, if your score, though, is much higher, let's say 760 or more, you'll actually qualify for a much lower interest rate. It'll be as low as about 4%. So the difference between a score of 620 at 5.5% and a FICO score at 760 or higher with a mortgage rate of 4% is 1.5%. And at first, that may not seem like a big difference, but if you think of it in terms of the size of a mortgage and how long we spend paying off our homes, A 1.5% difference for each $100,000 borrowed is $1,500 a year. So you can imagine with a $2 or $3 or $400,000 mortgage, that 1.5% difference is gonna mean thousands of dollars each year. And over the course of a 30-year mortgage, it's easily going to mean the difference of tens of thousands of dollars. It's a big deal. Credit scores matter. And of course, the higher your credit score, the lower your interest rate. It also means that your payments are going to be lower. And that would either allow you to perhaps buy a more expensive home, or just pocket the difference, save it for your children's education, or save it for retirement. Or whatever. So credit scores, when it comes to mortgages, really matter. It's more than just qualifying for the mortgage. It's how much you'll pay, and they can make a big difference with cars too. My FICO also has a page related to cars, and I was really surprised to see the difference in interest rates from, say, a credit score of 500. As compared to a credit score of, say, 720. At 500, according to my FICO, your rate on your car loan will be about 17%. But if you have a score of 720, you're likely to get a loan for about 3.5%. That's a big difference. It's 13, 14%, say, over a 5-year loan for $10,000 or $20,000. That's a lot of money. So FICO scores are important. And the good news is that today there are a lot of tools, either free or for very little money, that can help you assess where your credit score is and what you need to do to improve it. And we're going to be talking with Tom, and a lot of my questions for Tom dealt with those very issues. So I'm happy to have him on the show. As I mentioned, he is the credit expert at FICO. And I'm just thankful to him and the folks at FICO for agreeing to have Tom come on the show. So without further ado, Tom, welcome to the show.
Glad to be here. Looking forward to it.
Really appreciate you taking the time out of your day to talk with us. I've been blogging since 2007 about personal finance, and we cover everything from investing to getting out of debt. To saving for retirement. And I know of no issue that causes more frustration for folks than trying to understand their credit score. So we're grateful that you could spend some time with us today. As I mentioned earlier in the show, you are sort of the credit expert for the folks at FICO. And I wanted just to start off by asking you how you kind of got into this business. I imagine when you were a youngster and folks asked you what you wanted to do for a living, you probably didn't tell them you planned to be the credit expert for FICO.
No, I did not. I actually wanted to be a TV reporter, but I guess the gods have been kind to me and not put me into that particular profession. But the reason I got started in credit was after I got out of graduate school, I worked for Citibank for a number of years managing their pre-approved credit card solicitation program. So I was responsible for stuffing your mailbox with all those offers. And through that, I got a lot of exposure to the credit reports and how they work and how they operate, as well as scoring, because a bank like Citibank, when they're doing pre-approved screening programs, look very intently to understand if the consumer is going to pass their criteria from a risk perspective. And following that, I kind of morphed into not working for a bank, but working for companies that provide services to banks, such as credit scoring solutions. And so I've been with FICO for 15 years now and have worked in the scoring group, both with lenders as well as with consumers ever since, and have enjoyed it immensely and have learned a lot.
So basically, we have you to thank for all of those pre-approved offers we get in the mail.
Well, not anymore, because it's been a number of years since I worked for Citibank. But if you were getting them in the early 2000 time period, yes, you can write my name on a blog in terms of the one responsible for a lot of that.
Fair enough. Okay, well, we've got a ton of questions. I reached out to a lot of my readers and newsletter subscribers, and they gave me some great questions to ask you. And so I'll jump right into it. And I think as an initial matter, could you help us understand, the difference between FICO on the one hand and the major credit reporting agencies on the other, Equifax, Experian, and TransUnion. What are the differences between the two, between the credit reporting agencies and FICO, and how do you all work together?
Yeah, that's a really good question. It's an interesting kind of relationship web. So, the credit reporting agencies and the big three, they're known as Equifax, Experian, and TransUnion. They're responsible for capturing information on how you're managing your credit, and they can get those from a variety of different sources, such as public record information in the courts, like filing of bankruptcy. Collection agencies will send them information, and of course, your lenders, your consumers' lenders, will send them information in terms of how they're paying as agreed on various credit obligations, whether they're searching for credit through inquiries into their credit offerings, etc. And so the credit reporting agencies manage all of these huge databases of information on us. At the same time, lenders go to the credit reporting agencies to get access to information on us as consumers when we apply for credit, as well as on existing customers to make sure everything's remaining status quo in terms of how we're performing on our credit obligations. So through that interchange between the lenders and the credit bureau, there's a bunch of information that's being captured and stored on each of us as consumers. And so where FICO comes into the picture is we're not a credit reporting agency or credit bureau, so you can't come to my FICO and you can't come to Fair Isaac or FICO as a company and get your credit report because we don't have any information on consumers. So the way we go about building FICO scores and getting those FICO scores out to consumers and lenders is periodically the credit reporting agencies will send us a data sample which has been stripped of all personal identification information, so we have no social security number, name, or address on the data sets. And it will be a very large data set that's kind of representative of the US national sample. And what we do is we take that information and we build the FICO scores, so we find out what credit behaviors are most indicative of future risky performance in terms of not paying as agreed. And then we create that mathematical formula or algorithm, and then we put it in what we call a software box, and we send that software box to the credit reporting agency. So we have one for each of the credit bureaus, both Experian, TransUnion, and Equifax. And then that's installed in their system so that when a lender requests a credit report on a consumer who's applying for credit, the way it works is the system will access your file within that credit reporting agency's database. It then passes it through the scoring module or software box that we have there. It generates the score and reason codes and spits that back out to the credit report, who then displays it to either the lender or the consumer. So we act and interact very closely with the credit reporting agencies in terms of getting access to information and supporting the models, but it's really the bureau or the credit reporting agency who is distributing that information directly to either the lender or the consumer.
Okay, so the credit reporting agencies have the data, and FICO has the formula.
That is correct.
And so you kind of need both. You need the data to run through the formula that then produces a FICO score.
Correct. So information gets fed into our software module or box that sits in their system, and then generates the score and the reasons on why the score is not higher, and puts that back out to the bureau, who then can distribute it again to either the lender or the consumer, depending who's requesting that information.
Okay, so how does someone who doesn't have a FICO score, maybe they've just graduated from high school or college, they've never applied for credit, they don't have a credit file, they don't have a FICO score, how do they get one?
Right. So, for consumers who are new to credit, which could be, as you indicated, someone just turning 18 and entering the adulthood in terms of a credit perspective, or an immigrant coming to the U.S. who doesn't have any U.S. credit established history. The main way to start to get access to your FICO score is to establish credit with a lender. And there's different ways that a consumer can go about doing that. So one way is to apply with a lender directly and try to get credit through that application process. That tends to be a little bit difficult because unfortunately there's a little bit of a catch-22 situation here in the US that in order to get credit, you have to have credit. And so that consumer who, it doesn't fall into mainstream U.S. credit history is a little bit in a predicament there. So some other options that could be considered by a consumer is you could co-apply. It's called a co-applicant with someone who does have credit. So, for example, if you are needing a car loan, you could have your parents or a relative co-sign on the loan with you so that you're both legally responsible for the debt, but it would also be reported the payment performance on both of your profiles in the credit history, and therefore you could start to establish a credit report will then be able to generate a FICO score. Another idea is what's called an authorized user on a credit card. So if you know someone who has a credit card, preferably a family member or a close relation, you can ask them to call their credit report card company, and they can then have you put on the credit card as an authorized user. And the way that works is that once your name is on that account, when the credit card company reports to the credit reporting agency, they'll report it both for the primary cardholder as well as on your name, and it will help you get established with credit. Another
By the way, is that sometimes referred to as piggybacking?
Yes, that sometimes is referred to piggybacking, and the whole genesis of the authorized user feature within a card environment was set up way back in the ancient centuries of the 1970s to help, spouses who don't work get access to credit, and that typically was, the mother who stayed at home, and that's kind of the reason that whole started.
Okay. And I take it another option might be like a secured credit card?
That's true too. So many institutions will offer secured cards where you're required to put a down payment in kind of the format of a savings account, and then the credit card company will report that to the credit reporting agency, and it looks like a normal standard credit card trade line on the credit report, and it will get treated normally like any credit card. It's not identified as a secured card and therefore treated differently by the scoring algorithm.
Okay. And if someone follows, one or more of the suggestions you've just outlined, say they apply for a credit card or they get added on to a family member's card, how long will it take them before they'll see a FICO score?
Well, for FICO scores, we have 3 criteria to meet what we call our minimum scoring criteria. So this is the minimum amount of information we need to feel comfortable we can generate a score that has value and is predictive. So one of the requirements is that you must have at least one credit obligation being reported to the credit reporting agency. So that could be met by a credit card, a department store card, a student loan, a secure card, etc. So just one credit obligation. That credit obligation must have a date, an updated report date, so have been reported on within the last 6 months by the lender. And so what we're trying to get out there is the data shows us that we need to see some recent activity on that credit obligation to feel comfortable that we can generate a score that will have meaning for the lender. And then the third category is there cannot be any indication of deceased on the trade line. So a consumer that has a single credit obligation, such as a Sears card that has been open for 6 months or greater and has been reported on in the last 6 months, they would meet that minimum score criteria to get a score.
And can you give us some sense as to what the first credit score would be? I mean, I know it's going to depend on a lot of criteria that we're going to actually get to in a second. But if someone opens up a credit card and is, paying it on time, after 6 months, what kind of score can they expect?
It really depends, and it's hard to give a generalized answer on what the average score would be for someone just starting out. In theory, the consumer would be getting less points for what we call time and file characteristics. So that means we're looking at how long have you had credit and been able to show that you can manage that established credit. So you would think and could appreciate that points for that category would be less because the consumer just started credit 6 months ago. And then they could be getting positive points if there's no delinquency on the trade line, and they could get positive points if they are have low credit balances on those obligations as well. So the score could range anywhere across the whole score distribution of 300 to 850. It just really depends on what information is being reported and how that consumer has performed on that card when the score is being requested by the lender.
Okay, well then let's go to the factors that affect a FICO score. I believe on the MyFICO site you all list 5 factors. Is that right?
That is correct.
Okay, and let's just kind of go down one by one. The first one I think is length, and you've alluded to this, how long you've had a credit file or credit history, which is the kind of thing that consumers don't have much control over. You got your first account whenever that was, and I guess you just let time go by. But is there? Go ahead.
Not necessarily. So when we're looking at length of credit history, which by the way is not the most predictive category of the score, not the most heavily weighted, but important, we're looking at it in a couple different ways. So as you alluded, one way you can look at that is, how long has the consumer had credit? So did they get their first credit card in 1970 or 2013? So that is one way we look at the length of credit history in terms of kind of age of oldest credit obligation and how long that's been. But we also look at it in what we call average time on file. So basically what we're doing there is we're looking at all of your credit obligations and looking at the date that they were opened and averaging those out to understand on average across all your credit obligations or credit obligations from a particular category, how long have you had those established? So in theory, you could have someone that has 10 credit obligations on their credit file. They opened their first one in 1960, which would say, wow, that's a long time, right? They should get a ton of points for that. But if the other 9 have been opened in the last 6 months, their average time in file would be a lot lower, and they would look a lot riskier from that perspective. So when we're looking at length of credit history, we're looking at it in a couple different ways to really try to nail down the true risk of that consumer as it pertains to their history and ability to show a management of credit over the time period that they've had that.
Okay. Is there some magic number where you've had whether it's the oldest account or, as you've said, an average length of time that you've had credit, that where your score really starts to go up? 3 years, 5 years, 10 years, or is there some magic time that you start to see an improvement in a score?
There's no the magic number is 6.5 years. I like to think of it more of if you live in a hot climate in the summer, when the sun goes down at night, the thermometer starts to go down, and it's a gradual decrease over the evening time period, and not as soon as the sun goes down, it drops 20 degrees. And the point scoring system works similar to that in that, as your average time in file increases, you start to get more points over that, and as your age of oldest trade becomes older, you start to get points for that, and it's more of a gradual scaling of that point assignment versus a hard cut. And so it's difficult to give an exact answer. And the other challenge is that when people think about their FICO score, they think that there's probably just one big math program that scores everybody. And the way it works is there's actually a segmentation schematic within the scoring system, where the first thing we do is we try to understand kind of what your credit profile is, and then we send you through a scorecard that's been designed to be optimized for that credit profile. So for an example, if you think about your neighborhood or your own family, if you have a young adult in your household that is 19 years old and just new to credit, versus your own credit history, if you've had credit for 30, 40, or 50 years, the ability to predict risk is increased when we create scorecard segments that are created specifically to look at different segments of customers based on their credit profile. So we would have a scorecard built specifically for consumers with, let's say, a young, thin credit history versus consumers with a thick, robust credit history. And so because of that, the optimal number of years or months to have length of credit history can differ depending on what scorecard the consumer is going through.
Okay. And how many different scorecards are there?
There are 14 scorecards within the FICO system.
And does FICO publish details on those various scorecards?
We don't publish the exact segmentation schematic, but at a high level, the things that we're segmenting on are whether the consumers had a delinquency or late payment in the past or not as our first kind of segmenter or splitter. And then after that, we're kind of looking at um, depth of file, age of file, and credit activity.
Okay. Well, that's a good segue then. You mentioned delinquencies, and the second factor uh, is payment history, and I take it that deals with whether consumers are paying their debts on time.
Yes, that's correct. So when you think about a tool or a score that's built to predict how well someone's going to pay their bills in the future, one could appreciate that what's going to be the most predictive element is the history and observation of how they paid in the past. So when we look at payment history, that's the part of the score that's driving the majority of that score's value, probably around 35% of your score. And when we look at payment history, we look at it in what we call three kind of main categories or ways. So one way we look at it is in terms of the severity of the payment, mispayment. So the way mispayments are reported, you could be 30 days late, 60 days late, 90 days late, all the way through a charge-off status, which is basically 6 months late, or a foreclosure, a bankruptcy, tax lien, etc. So we look at the severity of the delinquencies that are being reported.
So, in other words, the longer, the worse it gets.
Well,
In other words,
the
the later the payment, the worse it affects your score.
well, the more severe the delinquency. So a 90-day late is more severe than a 30-day late, for example. And the reason I'm distinguishing between that versus what you said is the second way we look at it is recency. And so when we talk about recency, we're looking at how recently did that late payment occur. So did the 30-day late happen 36 months ago and the consumer was clean and current since then, or did it happen last month? And what we see in our analytics and the data tells us is the more recent that late payment occurred, the more predictive it is in terms of future risk. So a more recent late payment is going to get a harder hit in terms of point loss versus an older delinquency.
So how long does someone have to wait before a late payment has no effect on their credit score?
7 years when the
Wow.
late payment falls off. But again, going back to my analogy of a thermometer,
Yep.
if you look at a consumer profiles credit report and the delinquency is 5, 6, 7 years old, if the newer information and more recent behavior is all clean and current, the impact of that delinquency, while still predictive and still considered, is much less than if that delinquency happened 3 months ago.
So it stays on it affects your score for 7 years, but the effect gets smaller and smaller as it gets older and older.
Correct.
Okay.
And then the third way we look at payment history is frequency. So for that way, we're looking at, is this just a one-time occurrence of a 30-day past due? So maybe the dog really did eat the bill, or you were on vacation and you forgot to pay it, versus a pattern where we see multiple late payments and delinquencies across different credit obligations. And so, as you can imagine, the data tells us that consumers that have more of a pattern of missing payments are riskier than consumers that have an isolated, one-time late, and therefore the point assignment can differ given that frequency. So I was just going to summarize again. The way we look at those late payment information is we look at it in terms of recency, severity, and frequency.
Does it matter how large the payment was that was missed?
We do have characteristics that look at amount past due, but for the most part, the real drivers of the weighting in the model is the fact that the late payment occurred. And part of the reason for that is that when accounts get charged off on the credit report, a lot of times the lender will zero out the balance owed. And so therefore it's not provided on the credit report. And so because of that, a lot of times the amount of the delinquency isn't as relevant because it's missing information.
Okay, and I guess lastly on this one point, a question I get a lot is from folks that are like 3 days late on a payment, and they want to know whether that'll affect their credit score. Is there a certain time period? Do they have to be at least 30 days late before it can affect their score, or can even missing a payment by a day hurt your FICO score?
That's a question we get a lot here as well. And it really depends on the lender and the credit product that you're referencing. So I'll give some generalized observations, but I would encourage any consumer, if they're late on any payment, that they contact their lender directly to understand, that lender's policy. But typically speaking, for an installment loans, which would mean like your mortgage and your car loan, they're more likely to report you late earlier on your late payment behavior than, let's say, a credit card. So if you're a week, 2 or 3 late on your installment obligations, then there's a high likelihood that you could be reported to the bureau as 30-day late when they next report you to their information to the credit reporting agency. For credit cards, they tend to have a little bit more of a grace period, and so they'll still charge you late fees, but it may take them a little longer before they'll actually report you to the credit reporting agencies as late. But again, each lender's different, and so I highly encourage your readers and listeners that if they, let's say they were on vacation for a week and they missed their card payment or their auto loan payment, the best thing to do is to contact that lender immediately and explain, why you were late, get the money over to them as quickly as possible, and then ask them, has this been reported to the bureau, and will I see a 30-day late payment on my credit report?
Okay, that's good to know. All right, third factor, amounts owed. How does that factor into the score?
So your amount owed, or what we call level of credit indebtedness, is kind of the second most predictive category of information that is driving the score. And, a lot of times consumers get confused here as they think about it more in terms of like an income ratio. But your income is typically not reported, or if it is reported, it's inaccurate. So we're not looking at income information here. We're looking more at just what are the uses and balances on your credit obligations. And so when we're looking at this information, we look at it in a variety of different ways, but generally speaking, how you're managing your revolving accounts, such as credit cards, department store cards, home equity lines of credit, if they're revolving, they tend to be more heavily weighted in this category of information we're evaluating. And so the general theory here is that consumers who are more heavily extended, i.e. they're using a lot of that revolving credit that's available to them as a ratio, tend to be more risky and tend to get more points knocked off because of that type of credit behavior. So if you have several credit cards and you are almost maxed out on all of your credit cards, you're a much riskier profile than a consumer that has, a couple credit cards and is, let's say, 10 or 15% utilized on the available credit that they have.
And this is sometimes referred to as credit utilization?
Correct. So the credit utilization is a mathematical formula, but it's an easy one. So if you take your credit card statement today and you see that my credit card company gave me a $5,000 line, so that's the amount of credit that I have available to me. I'm currently at a balance of $2,500. You just take the $2,500 divided by the $5,000 to get your utilization ratio, which in that case would be 50%. So as that percent goes up, the amount of points lost increases because the data shows that consumers that are heavily utilized on their revolving credit are a much higher risk than consumers who have lower utilizations on their credit.
Okay. And, for those particularly that are maybe about to apply for a mortgage soon, or going to, their credit score is particularly important to them, is there a certain utilization they should aim for that might help them the most in terms of increasing their credit score or keeping it from going down?
Well, in that case, I would say the first thing to do is to pull your credit report and understand what your current utilization is, so you have a baseline of kind of where you are, right? And then you can then determine the actions to take to potentially reduce that utilization calculation that will allow for potentially more points. Again, similar to how I explained above, there's no one set magic number, but typically speaking, utilizations that are, in the the 1 through 15 to 20% range are where the most maximum points are being assigned. And as you can appreciate, the lower you get in that range in terms of the percent of your utilization, the more points you're going to get. So, the way the model works, it's not saying you should never use your credit card and you should always keep it at zero utilization, but it is saying that if you have lower levels of utilization, you're going to be more rewarded, given that the data shows you're much more or less risky compared to consumers with 50, 60, 70% utilization.
Okay. Okay, well, let's look at the fourth factor, new credit, which I think, correct me if I'm wrong, sometimes they talk about inquiries or hard pulls versus soft pulls. Can you tell us how this factor factors into the equation?
Sure. So inquiries are a very interesting topic because in the grand scheme of things, they're not driving the score. They're kind of the fourth predictive category, but they seem to get the most questions, and there's always seems to be a lot of interest in trying to understand how inquiries work. So let me try to explain it in a couple different ways. So as you indicated, inquiries are related to helping consumers understand when someone's touched their credit report. And there's different types of inquiries that are out there or that can be categorized. And so the two main categories are inquiries that are related to you, the consumer, who are out there actively seeking credit. And then there are other types of inquiries that are not related to you seeking credit. So if you as a consumer go to annualcreditreport.com and get a copy of your free credit report, you would see a bunch of inquiries related to lenders who pre-screened you for credit card offers, etc. And those would be inquiries that you should know a lender has looked at your credit report, but they don't factor into the score. So with the model and the FICO score, what we're really focused in on those inquiries that are more directly associated with you, the consumer seeking credit. So these would be inquiries where if you applied for a credit card in response to a pre-screened solicitation or on an online advertisement, if you're out there shopping for a new automobile or boat loan, a personal loan to finance a wedding, a student loan because your child is going to college or university this year, or mortgage, whether that be a new mortgage or refi. And so this again is where the consumer is actively seeking credit. And the reason we look at inquiries is because they're predictive. They are an indication that a consumer is seeking credit, and what the data shows is that those consumers who are actively seeking credit are inherently more risky than consumers who are not. Now, given that, again, I'd like to stress that overall, compared to how you pay your bills and your level of credit indebtedness, inquiries don't drive the score. The other part of the inquiry information that's important to understand is the models understand and try to accommodate how credit is extended in the United States. And so we have logic in the model that accommodates for rate shopping and the mortgage escrow process. So I'll spend a minute to describe that for your listeners so they can understand. So basically, if you went out this weekend and were at a car dealership shopping for a car and you're going to finance that car, sometimes the finance dealer will do what is called shotgunning. And that means they have relationships with different lenders that they do business with, and they're trying to find the best or most appropriate finance packaging for you as their customer. And so they'll make an inquiry on your credit report, but then they'll ask these banks that they have relationships with or credit unions to also come back with a package that they would have in terms of the interest rate they're going to charge for the loan if you would go with them. And so on the credit report, it may look like you have 7 auto inquiries in one day, but the model's smart enough to know to say this consumer's not trying to get 7 car loans. They're trying to get 1 car loan, and there's this rate shopping effect going on. So we have special logic in the model that treats for that event occurring in the auto space. And I'll get to that in a second. And the same thing in terms of mortgage process. So any of your listeners who've been through a mortgage loan process know that to get to escrow some takes 30 to 45 days. And during that time period, a lot of time the broker or the lender may pull your credit report several times to just make sure everything's correct, or if there was some information that was inaccurate and you got it fixed, they're trying to find out when it's being reflected in the credit report. So again, the model is saying, hey, this consumer's not applying for 10 mortgages. This is all associated with one mortgage underwriting process, and we need to have special logic to treat this appropriately. So for inquiries that are identified as mortgage, auto, or student loan inquiries, what we do is we ignore all the inquiries made that are associated with those particular types of credit searching in the 30 days prior to scoring. So, for example, if you were to go to an auto dealer today and they were to pull your credit report, the model would look backwards 30 days from this date, and it would ignore all inquiries that are identified as mortgage, auto, or student loan, and they will not affect your score.
Okay, so if I just kind of summarizing everything you've just said about inquiries, so there are certain kinds of inquiries that don't affect your score. For example, if you want to go check your own credit score, that's not going to be a ding against your credit or your credit score.
That's correct.
Okay. And if you do go seek credit, that is something that's reflected in your credit score, but as compared to the other factors, it's certainly not the most significant.
That is correct. So an inquiry may cost a couple points here and there.
Okay. And then I guess to your last point, when you're shopping around for credit, when you're shopping around for a mortgage, the fact that in the course of 30 days, your credit gets pulled several times, effectively that will really only count as one inquiry.
That is correct, over a certain time period.
Okay. And then the fifth and final factor is types of credit used. And how does that weigh into the equation?
Again, it provides some predictive insight, but not as much as the other categories. It's about 5% of the model. And here we're just looking basically, does the consumer have a mix of credit types of obligations, both installment and mortgage, installment and revolving, or is it all one type of credit? And we're also looking for if there's been any personal finance type of credit obligations being used, because the data shows that use of personal finance credit tends to be riskier and therefore can result in a little bit of a point loss relative to other types of credit obligations that consumers can use.
Okay, well then, for folks that want to improve their credit, we've kind of gone through in some detail these 5 factors. But for someone who just says, "Hey, I want to improve my credit," what's the 1 or 2 or 3 most important things I should be doing?
So the 3 most important things you can do to increase or maintain a good score is continue to pay obligations as agreed. If you're using credit, especially revolving credit, use it responsibly and in a limited fashion, and only apply for credit when it's absolutely needed. So if you follow those 3 kind of main high-level advice tips, then it'll either help you maintain your existing good score or help you put you on the pathway to improving your score over time.
Okay, great. One thing I'd mentioned to you earlier is this past week I went into my FICO and I pulled all 3 of my FICO scores from data based on all 3 of the credit reporting agencies. And each of the scores, is different. In fact, from the highest score for me down to the lowest, the range was about 60 points, which seemed kind of a lot to me. Why am I seeing 3 different scores? Is it because the data the reporting agencies have on me is a little different?
Right. So if a consumer is going out there and comparing scores across the reporting agencies, typically the main reason why scores would be different, assuming they're all pulled from the exact same point in time, is that there's some data difference or the way the data is being reported and displayed by the credit reporting agency is different, and that's most likely what's driving a large scale difference in score. There can be some differences given that each of the models at each of the bureaus is optimized for that particular credit reporting agency. But generally speaking, in my experience, if you see large differences in score, it's typically because there's a data element that could be different at one of the repositories versus the other.
Yeah, and does the 60-point spread surprise you? Is that something that I should be concerned with? That struck me. I was expecting all the numbers to be different, but I don't know. 60 points is seems like quite a lot.
Um, 60 points is quite a bit in terms of difference. So my guess would be, without seeing the credit report, that there is probably some kind of difference in the data from the one bureau that's the outlier. But if the scores are on the very, very high end of the distribution, then that 60-point difference wouldn't have as much relevance from a lender's perspective, because whether you're scoring 879 versus 840, I'm sorry, 799 versus 849, they're not going to change their decision on you for the most part, because they're going to consider you very low risk.
Okay. All right. Well, let me kind of rapid fire go through a number of scenarios. We've kind of talked in a way about the theory and how it's calculated, the FICO score is calculated. But a lot of my readers send in some sort of practical questions that they have. And so let me just kind of run down through them. And starting with mortgages, the first question is, what FICO score, minimum FICO score, do you need to qualify for a mortgage?
Again, that's going to vary, and it's going to depend on the mortgage lender, whether they're going through a Fannie Mae or Freddie Mac securitization program, the amount of down payment that you're putting on the house. So I know that sounds like a simple question, but it really varies and depends on the lender and the unique situation of that particular consumer.
Well, for Freddie and Fannie, I've heard that the minimum is 620. Is that accurate?
I've heard 620, and I've also heard 660. So,
Okay.
Again, it really depends, I think, on a variety of factors that go outside of the credit report and FICO score. So again, how much money you're putting down, the value of the property, your employment history, et cetera. And in today's environment, as we all know, given the crash of 2008, the process and the rigor of evaluation for mortgages has become much, much, much more deeper than what it was prior to the crash.
Okay. And whatever the minimum score is for a given lender, am I correct that is set by the lender? FICO and the credit reporting agencies don't determine what the minimum score should be.
That's correct. So for any institution, when they're making a credit decision, they go through a rigorous process of trying to understand what the profitability threshold is from a risk and revenue perspective, and then they determine the cutoff that will allow them to meet that objective. And what FICO guarantees is that the model rank orders risk, and that a 700 will always be less risky than a 600. But the exact cutoff and strategy that a lender deploys is made by their risk management group.
Okay. And is there anything that one should avoid doing in the, say, 6 to 12 months leading up to applying for a mortgage? Are there things that they should not do so that they can avoid hurting their credit score?
Sure, a couple things come to mind. So first of all, don't go and spend a bunch of money with a credit repair shop you see on the web because you don't really need to do that. You can go to, if you just want to get a copy of your credit report, you can get that for free at annualcreditreport.com. If you want to get access to your FICO score, you can come to myfico.com. Get your score, see what are the main reasons being communicated why your score is not higher. Those will be unique to your situation for each consumer. And then based on that, you can determine a strategy of where you need to focus. But generally speaking, if I were thinking about refinancing or getting a car loan in 6 months, what I would focus in on is making sure I'm paying my bills as agreed. So I don't want to risk a late payment hitting my file. Not being enticed by opening up a credit card in the mall to get a 10% discount off of merchandise for that day if I open up a credit card. So again, only opening credit if I need it, and then watching my spend on my credit card. So if I know that I want my utilization to be lower, then maybe start paying cash for certain purchases just to make sure that I can control that balance so that I look as good as I can when the lender pulls my credit report.
Yeah, one thing I noticed, you'd mentioned checking your score and like through services like MyFICO, seeing what's helping your score and hurting your score. I did that this week, and actually MyFICO it's a very easy to understand assessment of your score. You even have a scale with the things that are helping the score in green on the right, and the things that are hurting my score in red on the left. It was very easy to follow. Um, okay, so another question I get a lot is, how can someone improve their credit score fast? We always want to do things in a hurry, and sometimes you do want to improve your score quickly for some upcoming event. You've mentioned obviously paying your debts on time, keeping your utilization low, but is there any other sort of secrets, if you will, or tips that folks can follow if they want to improve their score quickly?
Well, it's funny you mentioned that because we're invited to, my wife and I are attending a wedding next week. And so my wife's trying to do a crash diet so she can fit in a dress. And I was like, maybe you should have started thinking about that 6 months ago
Yeah,
instead
well, you
of
didn't
like
tell her
2 years
that, did you?
ago. No, I was thinking
Okay.
it.
Well, now hopefully she doesn't listen to this podcast.
She's good natured because she said,
Okay.
I know. So the same thing goes with credit. So the short-term fixes are really going to be driven by kind of what is driving your score to be where it is. So you kind of need to know that as the baseline. And if you think about logically things that you would have the most impact on that you could change real time, a delinquency, if it's valid and accurate, is what it is. So you can't make that age faster, right? So it really comes down to if your level of credit indebtedness is what's driving your score to be lower. If you have the funds and can pay those off or pay those down more quickly, that's probably going to be your best bet in terms of any real-time quick fix. Just given how the model is looking at that other information that really isn't kind of available to be quote unquote quick fixed.
Okay. Well, listen, I appreciate your time. I thought you've been letting me ask you question after question for about 45 minutes, and I appreciate you taking the time with us today. Let me just kind of wrap up with this final question, and that is, you've obviously been in this business a long time. Do you come across things on the internet or on the news about credit that are just not true? Credit myths that you hear sort of regularly that aren't accurate?
Sure. So I live in the Bay Area, and one thing that always irks me is when I'm driving on the radio, there's an advertisement that says, basically, it's a mortgage company advertisement, but it basically says, blah 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 about 30-day late, and they imply that everybody has a 30-day late now and then, don't worry about it. And that's very misleading, because if that 30-day late gets posted to your credit report and it's recent, then it can have a fairly substantial impact on your score. So don't be under the illusion that minor delinquencies won't hurt your score. Now, obviously, a 30-day late's not as hurtful potentially as a bankruptcy, but they still count. The second thing is, I often hear kind of the scenario that a low score or a bad score will haunt you forever. And again, this is a misnomer. I think one of the things that we're most proud about for the FICO score is that it's a healing score. So as a consumer changes their behavior and starts to pay bills on time and pay down balances that are owed and not opening credit unless they absolutely need it, they'll start to get points and their score can increase over time. It may take some time, but it definitely will happen. So a poor score will definitely not haunt you forever. And I guess the third advice or item I'd point out is that You don't need to pay a bunch of money to some entity like a credit repair organization to help you get your credit back in order. There are tons of free services with reputable entities, whether that be your lending institution, big entities like Visa, MasterCard, etc., that have a lot of information to help you get your finances in order. And so before you fork over, $50, $60, $500 to do that, take advantage of those free resources to help you out, such as this podcast. And you don't need to pay for helping to get your score up and giving you access to more affordable credit in the future.
Okay, Tom. Well, I appreciate it. I appreciate your time today. If readers email me with some follow-up questions, because there's no way I can cover everything, is it okay if I reach out to you in an email and perhaps get some follow-up questions answered?
Absolutely. And again, I like to reference the MyFICO site. I mean, obviously, it's there for consumers to get access to their FICO score and credit report, but it's also kind of the Carnegie Library of information about credit scores and lending. So there's an educational tab on our website that just has a plethora of educational information about scores. So if they need information in real time and can't get a hold of you or me, then that's a good secondary resource to go visit.
Okay, terrific. And I'll make sure to leave links to those sources in the show notes. All right, Tom, appreciate it. Thank you so much.
Enjoyed it very much, and good luck to all your listeners out there.
Great. Take care.
Bye.
I hope you found the interview with Tom helpful and informative. I really appreciate his time and coming on the show. One thing I wanted to mention is, as I indicated in the interview, I do get my credit scores from MyFICO. You can get one score for free for signing up for a trial of their Score Watch program. I actually did that and then purchased my other two scores, and it was very helpful in understanding not only where I stand, but also to understand what's hurting my scores and what's helping my scores, which is particularly important if you know you're going to be borrowing soon to buy a home, or you're looking to refinance your mortgage, or perhaps you're going to get a loan for a car. It's important to understand where your FICO score is and give yourself a chance to improve it so you can get better interest rates. So if you want to check that out, it's easy to do. Just go to DoughRoller.net/myFICO. That's /MYFICO. That will direct you to the page where you can see your one FICO score for free. And of course, as I did, if you'd like, you can purchase your other two scores. And so with that, that's the end of our second podcast. Hope you enjoyed it. You'll be able to find the show notes, as I mentioned, for the episode at DoughRoller.net/podcast2. If you're not already a subscriber to our newsletter, you can do that quickly and easily at DoughRoller.net/newsletter. And as always, feel free to reach out to me with questions or comments about the show or questions about anything related to do with finances. And you can reach me at DoughRoller.net dr@DoughRoller.net. You think after 7 years I'd know my own email address, dr@DoughRoller.net. That brings our show to a close. Until next time, remember, the best thing money can buy is financial freedom.